we delve, though, into the lesson, let us set its objectives. At the end of the lesson, students should be able to define the word stock, list correctly the 4 accounts that show the movement of stock. Students, at the end of the lesson, you should also be able to explain the usage of the 4 accounts used in the recording of the movement of stock. Students should be able to record how the purchase and sale of goods by both cash and credit are posted to the ledgers. Last but not least, students, at the end of the lesson, you should be able to prepare ledger accounts to show clearly how the return of goods are posted in the ledgers. Sound practical? Come on, let's go. Can you recall, students, ever seeing the juice truck or the delivery van driving through the school gate, getting ready to make a delivery? Can you further recall an instance when mommy or daddy had to return something they bought to the shop, whether online or otherwise? And have you or possibly a classmate ever had to return something to the tuck shop, probably a stale bun? If your answer to one or at least one of these questions was yes, then with ease you should understand this topic, the asset of stock. But first, let's set a precedence. Let's find out what is stock. Any thoughts? Anyone out there? What is stock? All right, I'm hearing goods. All right, you're on track. Now, stock refers to goods bought previously which have not yet been sold. Goods bought previously which have not yet been sold. From all indication then, students, it sounds to me like we bought the stock in order to sell them back. Good? But while they're in the business, shelved or in the warehouse, yet to be sold, we will refer to them as our stock of goods. Now, students, the dealings of stock is relatively plenty. Sometimes we buy the stock, sometimes we sell the stock, sometimes you have the stock returning. Good? Either we, as the business, return it to our suppliers, or our customers return it to us. Now, as accountants, we try to be very systematic and orderly. So what we do, we actually set up 4 accounts in order to maintain or to track the movement of the stock. 4 accounts. What are these 4 accounts? Now, they are 1, purchases, returns outwards, sales, returns inwards. Let's go again. Purchases, returns outwards, sales, returns inwards. Now, listen carefully before we look at each of these accounts individually. 2 of these that we just mentioned actually cause the volume of our stock to increase, while 2 cause the volume of our stock to decrease. Can you guess which one does what? Purchases, increase, sales, what? I don't know. Think. Well, purchases and returns out inwards will cause an increase in stock. Purchase, we buy it, don't it? So we get it, don't it? We have more, right? So it causes an increase in stock. Likewise, returns inwards, and you'll see or better understand this a little later. Sales and returns outwards will cause a decrease in stock. Go ahead and reason that one. Now, as I'd said before, let's look at these accounts individually. Purchases, students, refer to stock or goods bought for resale. All right. Now, this can be done on a cash or a credit basis. Listen, I know. Make sure you have your pens, your papers, your ledger sheet, your calculators. If you don't have that, go and get them quickly. It's class time, and that will to win. Now, when we purchase goods, how do we record this in the ledger? We would open up a what? We would open up a, very good. We would open up a purchases account. Now, we can't pack all of the transactions related to stock in one big stock account. No, that may cause confusion, students, and we need to track the movement of the stock very carefully. So therefore, when we buy goods, we will open up what we call a purchases account to record those transactions. Now remember, stock is an asset. Good. And what type of asset is it again? A current asset. Good. Now, therefore, the rules that govern asset, students, the double entry rule that governs asset will also govern purchases, because purchases here is reflecting our stock bought. For refreshment, the double entry rule that governs asset states that whenever there's an increase in asset, we do what? Debit. And whenever there's a decrease in asset, we will credit. So therefore, when we purchase goods, students, we're going to have a what? Increase. So what will we do to the account? Very good. You're learning, man. Every child can learn and every child must learn. We will debit the account. And when there's a decrease, we're going to do what? Credit the account. All right, good. Moving on. Now, purchases, as said, represent an increase in stock. Therefore, what will we do again to record goods bought for resale in the purchases account? Will we debit or will we credit? If you were listening, we will debit to show an increase. Now let's analyze this example together. Ready? Good. March 2, 2016. We bought goods for cash, $200. We bought goods for cash. Whether we did have goods before or we never have goods, none at all. We've bought. If we're even moving from 0 to 1 or from 1 to 2, volume increasing or decreasing? Increasing. Good. Now, which two items would be affected by this one transaction? I am hearing goods, all right, and I'm also hearing cash. Let's go back to the first response that I just got, goods. Tell me what happened with the goods here. Did we buy the goods? Of course, we bought the goods. So which account again will we open to record this transaction? We will open up the, boom, purchases account. Very good. You're learning, man. All right. So therefore, when you see bought goods, students, do not open up an account and call it goods. Tell me the specific dealings of the goods. And that is that we have what? Bought the goods. So we're going to open up a purchases account to represent goods bought. And secondly, we're going to open up a cash account. Good. Now, the purchases account will be debited to show an increase in stock, while the cash account is going to be what? Credited to show a decrease in cash, which is an asset, all right? And stock is increasing too. That's why we're going to debit the purchases account, and stock is an asset. Demonstration. You would have had your ledger sheet. Rule up. We're opening up the purchases account now. Good student? Don't forget, the left side of the ledger is always the debit side. The right side is the credit side. Now we just establish it that we're going to debit the purchases account, didn't we? Which side again is the debit side? The left side. Good. So you go to the ledger sheet now, students, and you enter the date. Which day did the transaction take place? March 2. Which year? 2016. You put that in the date column. Now, if you notice, I'm in the purchases account. The amount that we bought the goods for was $200. Good. Who say you not learn? So you put the $200 under the amount section. What is the name of the other item that was affected by this one transaction? We just said it. Cash. So therefore, in the details section, you're going to write what? Cash. Now, the cash account is found in which book? Or, come on, we spoke about that. It's found in the cash book. Because remember, the cash book is made up of both the cash account and the bank account. Good. So in the folio, you're going to put what? CB. And CB here stands for cash book. And this will tell us where we can find the other half of the double entry. See there, students? Debit the purchases account to show an increase in stock, March 2. And in the cash account, of course, it will be on the credit side looking like this. March 2, purchases, general ledger and the folio. Because the purchases account will be found in the general ledger. So you put it right beside purchases here. And the amount is $200. Not bad, not true. Getting it. Just remember, we're dealing with stock. And the double entry rules that govern asset govern also all the stock accounts. Now reason this one on your own. 2016, March 6, credit purchases $3,000 from T. Tom. Credit purchases. In our Jamaican language, native tongue, give me another word for credit. In this case, trust. Yes, we trust T. Tom's good. So we buy the goods, but we haven't paid T. Tom yet. How would we post this in the ledger? Credit purchases, $3,000 from T. Tom. Reason. The answer, you would debit the purchases because, again, students, we have bought goods. We have increased in stock. Stock is an asset. Whenever there's an increase in asset, we debit the account. And, of course, we're going to credit T. Tom because we're increasing in liability. We've incurred a creditor. You see, you have to try and remember all of the lessons that I taught you before, because we're building. You cannot forget your basic principles, right? We will always recall, and I'll always ask you to refer back, so you cannot forget the basic principles. Good. Now, here it is. Here in the ledger, say March 6 in the date column, 2016. On the debit side of the purchases account, because we're increasing in asset stock. Good, we put in the date. We put in the amount, which is what? $3,000. And the details will be what? T. Tom, and T. Tom is a creditor. So where would we find T. Tom's account? Go back to last week's lesson or even the one before. Creditors, trade creditors accounts are found in the purchases ledger. So in the folio, what will I have there? Not GL. We're going to have what? PL for purchases ledger, telling us that T. Tom's account is found in the purchases ledger. And if you notice, I have a numeral 3 there. Says the purchases ledger, page 3. Remember now, and me make up the page number. All right? Good. In the exams, they can give you the page number, or you may be asked to make up your own. So we're moving along. The corresponding entry would be in T. Tom's account, our creditor, in the purchases ledger. And remember now, we're increasing in this case in liability, so his account will not be debited, but his account will be credited. You were taught. Practice, practice, practice. You can't forget to practice. We're building students. So then, supposingly some of the goods that we bought, right, were spoiled, what would we do? No, I don't think we'd want to do that so quickly. Throw it away. That's an option, yes. But tell me something else that we could do. Return it, of course. We could take it back to the supplier to say, hey, the box milk spoiled, you know. Can we have an exchange? Good. Now, students, what kind of movement this for the stock? Is it coming in or going out? It's going out. And we're making a what? Give me an R word. I can't hear you. Project your voice some more. A return. Good. Therefore, students, if the goods were spoiled, what would we do? We would actually register or record it as in returning it, or after returning it, that is, we would record it as a returns outwards. Now, students, returning the goods, will it cause the business to have more goods now or less goods? We return it. Less. Good, because we no longer have it on the shelf or in the warehouse, don't it? Good. Now, students, it therefore goes to reason that this returns outward is going to have an effect on the amount of stock that we have. Good? A decreasing effect. What does the double entry rule say again? Whenever there's a decrease in asset, we will do what? Credit the account because we have less. So which account do you think we're going to open up now to record the goods that we are sending back to our supplier? We're going to open up a what? Think. But just before you give me your answer, let me give you a trivia to see how much you're learning. Based on the double entry principles, students, how is stock classified? Is it classified as a liability, capital, asset, or revenue? The answer is coming up. Just think. Now, let's go back to the return of the stock to our suppliers. So we're sending them out to the supplier, and we are making a return. And we're going to call this movement returns outwards. So what type of account then do you think we need to open up? Can we put those goods in the purchases account? No. If you do it, CSEC mark you wrong because you never buy the goods, you're returning the goods. Therefore, students, we will have to open up what is known as a returns outwards account. Remember, every dealing of the stock or our stock have its own account. If we buy, we're going to record it in the purchases account. If we return the goods to the supplier, we're going to record it in what we call the returns outwards account. Students, let it stick. Now, another name for the returns outwards account is the purchases returns account. Makes sense, not true? Purchases return. And when we buy, we're returning. Stock bought for resale is now being returned. So we call it the purchases returns account or the returns outwards account. Now let's look at an example. You remember on March 6th, I think, we bought some goods from T-Tom. Now March 13, we decided that we're going to return some goods to T-Tom. Now, which two accounts would be affected? Give me one term for return goods to the supplier. That would be what? Returns outwards. So we're going to open up then a returns outwards account. account. Returns outwards, again, student, is representing our stock movement. Are we going to have more stock now, or are we going to have less stock? We're going to have less. Whenever there's a decrease in stock, which is an asset, we should do what? Credit the account. So we're going to go then on the credit side of the returns outwards account. We will put in our date. Yes? And what's the date? March 13. And the year is what? 2016. The amount was how much? $50 worth of goods are being returned. So we put the amount under the amount, $50 under the amount section. Notice the details is blank, and we're in the returns outwards account. What will we write in the details? The name of the other item that has been affected, and that would be what? T-Tom. Very good. Folio is absent. What will we put in the folio column? Where will we find T-Tom's account again? In the purchases ledger. Very good. And why? Because he's a creditor. Telling us and I learn, you know. Just keep on keeping on. Success is on the way for you. Now, this is what we would have on the credit side. See it? Easy like cheese. Once you bear in mind the double entry rules, you have nothing to fear. All right. And of course, that's a credit entry in the returns outwards account. So this is what it would look like for the debit entry in T-Tom's account. And we'll be reducing in liability because we're giving back T-Tom's goods, right? So we're going to debit T-Tom's account. Not bad, don't it? So we can buy goods, and we call that what? Purchases. That's one movement. And we can also return goods to our suppliers. And we call that movement what? Returns outwards. Now, students, there's another dealing as it relates to stock. We can also what? Sell goods. Now, one word that describes goods sold, we call that what? Sales. Let me show you now. Focus your attention on the whiteboard. Now, sales can be done on a credit or cash basis. And remember, sales refer to goods sold. All right? Can be done on a cash or a credit basis. Yes, I can sell some persons their goods, your customers' goods, and then pay you right away. Or some customers may give you an IOU. Next week when them get the partner, who to tell? Now, how would we record then sales in the ledger? We would open up a what? Think. Miss Wicked today, she just have you thinking. No, this is teaching. You have to think. We would open up what we call a sales account. Good. So purchases account for goods bought, returns outwards account for goods returned to our suppliers, and sales account for goods sold. Hope you got that right. Now, when we sell goods, does sales represent an increase in stock or a decrease in stock? Will it cause us to have more stock or will it cause us to have less stock? Less, of course. We sell the goods. All right. Now, will we debit this account then or credit it? Come on, we're talking about stock. We sell some goods. Stock is an asset. Whenever there's a decrease in asset, what should we do again? Credit. Good. So where we would credit the sales account. And another thing is that sales is our revenue, and we're increasing in revenue, but so we would credit the account, but that's for another lesson. Let's look at it now from the perspective or the angle of being a stock. All right? Stock account. Now, let's analyze this transaction. 2016, May 10, credit sales to M. Mott. You know what that means? We sold goods on credit to M. Mott. Which two items would be affected here? Don't tell me credit sales. Yes, sales and MOT. So therefore, we're going to need two accounts. We're going to need the sales account, and we're also going to need MOT's account. Now, sales will be representing a what? Increase or a decrease in stock? Come on, pay attention, focus. Yes, it's going to represent a decrease. Beautiful. Stock is an asset. Whenever there's a decrease in assets, what are we going to do? Credit the account. So here we would credit the sales account and we would debit MOT's account. Don't forget, again, reminder, increase in asset you debit, decrease in asset you credit. All right? Double entry rules for assets. And stock is an asset. Now, demonstration on the credit side of the sales account. Here we are crediting because we are having a decrease in stock, which is an asset. We put the date in, March 13. We put the amount, $350. And in the details, we will have MOT, the name of the other item that was affected. Folio is empty. We sold goods on credit to MOT. What did I teach you before? Persons whom we have sold goods to on credit are known as our what? Trade debtors. Good. And our trade debtors are found in accounts, are found in which ledger? Sales ledger. All right. So in the folio account, you should have sales ledger. Again, or SL. Again, I have a 6 beside it, and that represents the what? Page number. And who made it up? Me. All right. Good. Now, MOT's account would be debited to show or to complete the double entry. All right. Now, imagine for a moment that we sell the goods to MOT. But there was a box of milk that MOT didn't order in terms of brand. Wrong brand was sent to her. What do you think she should do with the milk? Drink it anyway? No. She probably can't do that. What if the brand happened to hurt her tummy when she drinks it? You want her to have diarrhea? What do you think she can do? All right, of course. Return it to the business and ask for an exchange, don't it? Now, students, what type of return is this? Is the goods coming back to us or is it going out? The box milk coming into us, it's being returned to us. So what type of return you think we're going to call that? Think. All right. Returns inwards. Remember now, returns outwards when we send it back to the supplier. Returns inwards when the what? Customer returns it to us. Inward movement. Now, what are some common reasons for returns inwards? Wrong order, quantity, size or description, and probably spoilage. Could be a case where the box milk was even spoiled, you know, and the young lady couldn't drink it, so she had to return it to us. Or possibly the product was damaged on arrival. Now, when there's a returns inwards, we normally write up what is known as a credit note. Go and research it. And when there's a returns outwards, we normally write up what is known as a debit note. I'm going to ask you again, you know, at another time when you least expect it. So make sure that you can differentiate between a credit note and a debit note. All right? You're laughing? I'm not joking. All right. Now, don't forget that the fact that the goods come back to the business, we call it returns inwards. Hence, we will need to open up a returns inwards account. And another name for the returns inwards account would be what, students? Let me hide it. When we bought the goods and we returned it to our suppliers, we called it what? Purchases returns, don't it? So what do you think we're going to call this one if we sell the goods and the customer carry it back to us? A sales returns. Good. So another name for the returns inwards account is the sales returns account. Don't forget. Now, let's try this. March 18, L Love returned goods to us $450. Which two items would be affected? Remember now, every time you get the transaction, you must identify the two items that are affected. Then you apply the double entry rule accordingly. Now, L-Love returned goods to us $450. Which two items are affected? What are the two nouns? L-Love and goods. All right? If you say goods, I agree. But remember, you can't just open up an account and call it goods account. You must specify the movement or the dealing of the goods. So what happened here with the goods? L-Love returned the goods to us. Good. So which specific account you're going to open up now to track this transaction? Returns inwards. So the two accounts that we would need now would be L-Love and returns inwards. So L-Love returned goods to us, $450. Let's see how we would do that in the ledger. But just before we get to that, let me just tell you, but an alternative name for returns inwards account is what? Is it the purchases account, the sales account, the purchases returns account, or the sales returns account? Answer is coming up. And if you ever get it wrong. All right. So March 18, 2016, L-Love returned goods to us, $450. The goods coming back to us will cause an increase. If you said decrease, you're wrong, because we are getting back the goods. So we have to record it. All right. So returns inwards is a stock account being governed by the same double entry rule that govern all assets. So whenever there's an increase in asset, what will we do to the account again, students? We're going to debit the account. So here we come now on the debit side of the return inwards account, students. 2016, March 18. You see that in the date column. 2016, March 18. Debit side. The amount of goods that L-Love returned to us valued $450. So in the amount section, you're going to record $450. Details column here is blank. What should I write? Come on, child, pay attention. What should I write? I'm in the returns inwards account. The name of the corresponding item or the other item that was affected, which is what? L-Love. Look for the nouns. L-Love. So in the details, I'm going to put L-Love. And L-Love is a debtor, trade debtor. So L-Love's account would be found in the sales ledger. And of course, we make up the page number again, students, page 4. So that would be the debit entry showing the returns inwards. And you can do the credit entry to show how it would look in L-Love's account. All right? Now, answer to trivia number 1. Based on the double entry principles, how are stock classified, or how is stock classified? Very good. Stock is classified as an asset. Wonderful. And our answer to trivia number 2, an alternative name for the returns inwards account is the sales returns account. Now, what are the key points emanating out of today's lesson, students? The double entry rule that governs the stock account accounts is the same that govern assets. The 4 accounts which are used to keep a check on the movements of stock are 1, say it with me, purchases account for the what? Purchase of goods. 2, sales account for the what? Sales of goods. 3, returns inwards account for the what? For goods returned to the business by customers. Returns outwards for goods returned by the firm to its what? Suppliers. Continuing, key points. Purchases account always carry a debit balance. It's a stock item. However, if we happen to credit it in error, right, then it may differ. The sales account always carry a credit balance only in the case when we had initially debited it by error. I have a third trivia for you. Which of the following is entered in the purchases account of a grocery store? And I see this as a very common multiple choice question, student. So you can mark this one. Which of the following is entered in the purchases account of a grocery store? Is it A, computers, B, goods for resale, C, office stationery, D, duplicating machines? Of course, the answer is goods for resale. Now I want you to take a snapshot of your assignment. You're going to identify the specific movement for each stock below, or identify the specific movement of stock for each of the transactions below, and then post them to the ledgers. 2016, March 10, sold goods for cash, $10,000. Same 2016, March 12, bought goods on credit from D small, $5,000. March 16, we returned goods to D small, $30. Students, we've had a wonderful class, I would want to assume. I just want you to remember this and remember it always. And I'd like for you now to focus here on the whiteboard. The 4 movements of stock, we always end it with the letter S. Students tend to make an error and say sale, purchase, return inwards, return outward. No, keep the S. So we have sales, purchases, returns inwards, and we also have returns outwards. I love to point this out, the S, because the S represents the letter that start the word stock, don't it? So don't forget, our 4 accounts that show the movements of stock or track the movement of stock are sales, purchases, returns inwards, and returns outwards. Students, that's all for today's lesson. I'm Latoya Chambers-Hogg, and it's been a pleasure being with you this morning.